objective. And thank you to you, Mr. Cummings, and to you, Sir Douglas, for attending and sharing your views with us. A list of the interests of the members relevant to the inquiry is available online. The session is open to the public, is broadcast live, and is subsequently accessible via the parliamentary website. A verbatim transcript will be taken of the evidence and will be put on the parliamentary website. A few days after this session, you will be sent a copy of the transcript to check it for accuracy, and it would be helpful if you could advise us of any corrections as quickly as possible. And if after this evidence session you wish to clarify or amplify any points made during your evidence or have any additional points to make, you're welcome to submit supplementary evidence to us. Would either of you like to make any short opening statements?
Thank you. I'd like to thank the committee for the invitation to come along today. My name is Chris Cummings. I'm the Chief Executive of the Investment Association. The Investment Association is the representative body for the UK buy-side. Amongst our member firms, we have major international global investment firms, organisations such as BlackRock, Schroders, I'm delighted to say Aberdeen, through to boutiques running a few hundreds of millions of pounds. Our members cover all types of investment philosophies, approaches, public and private markets, and we also represent the world's largest buy-side fintech community as well. We have offices here in London, across in Brussels, and also in a presence in Washington DC, which I think gives us a comprehensive view of the investment market in the UK, representing an industry that is one of the UK's few truly global successful industries. I mentioned the £9 trillion that our members manage. About £4 trillion comes from the UK, £2.5 trillion approximately from the European Union member states, and around £2.5 trillion from other parts of the world, and that's the part of our investment that's growing fastest, which is why I can confidently say we are a truly successful global industry, accounting for about 5% of our nation's export earnings already. I think this committee is incredibly well timed and look forward to answering your questions.
If I can make a couple of comments. Douglas Finn, I chair Aberdeen, which is a UK-based but international asset and wealth manager. I'm fascinated by this secondary objective on growth because I think it's timely and important. I think the work that's been done recently in looking at why the UK has not grown as fast as it might have done if it had kept up with its international peers begs a number of questions that the work of this committee is very well positioned to look at. Indeed, our industry is very well positioned to respond to. Some of them are political choices, but this committee can inform policymakers on the basis of the facts that they gather. I highlight four things, and the first thing is one of the things that got me into this industry in the first place. First of all, are we as a nation saving enough money? Now, that's a political choice in part, but also the financial education aspects of are we saving enough money for the future needs, particularly retirement, I think is a relevant question for our industry and for regulators. And of the money being saved, is it being saved optimally? Is it in the right place? A lot has been highlighted recently in the large amount of money sitting in cash accounts, which there are many, many reasons to do that, but is that the optimal place for them to go? If it's not the optimal place for them to go, where would we like that money to be invested, to be allocated? And then from the point of view of this committee and what we think about is, are there regulatory barriers to the optimal allocation of money if such a thing can be defined? And we talk about, are we getting enough money to early stage companies, to scale up companies, to infrastructure, long-term assets? The second and final thing I wanted to say is that in terms of investment too, I think it is a relevant question for our industry, a relevant question for our regulators, a relevant question for policymakers is our industry investing enough money in its own future? Is it capable of investing enough money in its own future? And can it attract the capital it needs to invest in its own future? When you think of the amount of money that's being spent, particularly in the United States, on data and AI, which will absolutely revolutionise this industry, is the industry in the UK, and given that the part of the remit of the FCA is to create a healthy and successful financial system, without investment in that system, it will be hampered in so doing. So the question, I think, that's relevant for us as an industry and for you in your work and looking at the work of the regulators, are we doing enough to create an industry that's capable of attracting the capital, investing the capital, to make it relevant and successful in the future?
So Douglas, these are all really important points. Have you any specific recommendation, not necessarily now, I mean, perhaps you could provide them to the committee in writing, what actual things could be done in order to achieve these objectives?
Well, I will do that, but I would say I think one of the things that the regulator could be charged with is if there are gaps. For example, if it is the case that we believe that not enough money is going into scale-up capital, not enough money is going into early-stage capital, not enough money is going into infrastructure, might the regulator be charged to say, if these are gaps that Parliament, that policymakers have decided are gaps, what have you done in terms of your regulatory analysis to make sure that you are not contributing to obstacles and barriers? And then, show us the evidence of is more money going into areas that we have decided as a policy framework we'd like to see. What have you done to facilitate that? So these are my thoughts, but I will be more expansive in writing.
Yeah, thank you. It really is a neat segue into the question I really wanted to ask you, which was about Nicola Rathy's speech at the Mansion House. I'm sure you were probably there to hear it, where he talked about the need for a mature debate about risks, and argued that could lead to growth, but with trade-offs. Do you agree with that view? And if so, who should be taking the steps on this? I mean, should it be the government or the regulators to lead the conversation in identifying and making these trade-offs and setting a risk appetite? We've also had evidence, most notably from Howard Davis and other former regulators, who said, well, it's all very well, but the politicians, as soon as something goes wrong, blame the regulator for not regulating enough, and that really sort of crystallizes the issue which Nicola Ratty was raising, perhaps with a little bit more tact. What is your view?
I think he's right to say there are trade-offs, but I also think the word risk is used too loosely. It's a very broad word. It's a bit like fairness. I think there are three types of... When people talk about risk, I think they're talking about three separate things. One, are we creating an environment where we are disincenting retail consumers in particular from investing in products and services that have a higher variability of return? So, at one end, government bonds, at the other end, maybe infrastructure or something where it's a riskier asset, but the returns could be higher, but they could also be riskier, and therefore they could be lower. So part of risk is variability of return. Second part of risk, which the regulator does get very concerned about, interested in, is operational resilience. So what are the risks within the system that something could go wrong that could create consumer harm because the operational strength of organisations is not sufficient? And the one that's obsessing everyone at the moment, banking and asset management, wealth management, which is actually a real risk, is what happens if one of the big cloud providers fails? I mean, horrendous question, and little organisations like us can't solve Amazon Web Services, but it is irrelevant. So what risk is the system prepared to take in terms of operational resilience? And then the third thing, which I think the system should take no risk in, is governance. Are the people that are managing money on behalf of consumers, are they properly qualified? Are they properly overseen? Do they have the skill set, and do they have the ethical behaviours to do that? If they don't have it, they shouldn't be in the system. I mean, no, there's no risk that should be accepted on governance. But the other two, I think variability of return, if it's transparently disclosed, is absolutely right to show to people these are the range of options in terms of your investment choices. These are zero risk but lower return. These that have higher variability of return, and you could decide whether you have a preference for it. And then there's something in the middle, which is around how secure do we want the belt and braces to be in operational integrity, because obviously you make the system more and more expensive if you have belt braces, bolts and everything else to deal with every conceivable eventuality. And I think one of the things that's grown up in the back of the financial crisis, properly so, but we could have a debate about whether it's gone too far, as to whether the demands on financial resilience, i.e. protecting against anything that could conceivably go wrong, begin to start to constrain people from doing the things that on a risk-return basis might be the right things to do, but they do come with a certain amount more operational risk because there's a complexity.
Mr. Cummings?
I would absolutely agree with what Sir Douglas has said, and really applaud actually the fact that Nicol used part of his speech to comment on what we're calling an overabundance of caution, safetyism, that's affected the system probably since the global financial crisis, where we've seen an attitude to risk develop across policy making and regulation and indeed in the industry. So I don't think this is a case of finger pointing, it's a collective conversation that we need to have, which is less about trade-offs and more about course correction. At the moment in our country, we've got around 15 million people who've got more than £10,000 sitting in cash savings. And I wonder if we've gone too far in protecting people and we've protected them out of the capital markets. We've seen ownership levels, investment levels fall since the 1980s. Where we end up now is a situation where if you want to get into debt, if you want to take out a credit card, you can do so online in a matter of moments. But if you want to start investing, the first thing you're going to encounter is a disclosure regime which starts off with phrases such as your capital is at risk. You could lose every single penny that you want to put in. So there's no calibration of risk, and I think that immediately erects a barrier to people saving. And we've seen different characteristics. Certainly, young men are more likely to be engaging in crypto than they are to take out a simple stocks and shares ISA. More men than women do because they're put off by the wealth warnings, the health warnings. And so we're calling for a bit of a course correction to say, firstly, the greatest risk is taking no risk. If you opt out completely, then you're in cash savings and you're going to be subject to the rigours of inflation. Starting to save is a good thing, but investing is better. And then have a grown-up conversation between the regulator and the industry where we can actually reset the risk tolerance, not only for our industry but for the nation. Because I think many of us know that if I think about pensions, we're facing into a generation of pensioner poverty because people have not had the opportunity to think about how much money they should be saving into pensions. And I'd simply contrast us finally with the US. This year they're celebrating 100 years of the development of the mutual fund. Of course, our Scottish colleagues, my father in particular, would remind me that these things were invented in Scotland a lot longer ago. But still, 100 years of the mutual fund, and that has been the greatest tool to democratise access to capital markets, where now up to 2/3 of Americans invest in stocks and shares outside of their pension. 2/3 compared to less than a quarter here in the UK. So there's a conversation we need to have about how we build up our nation's attitude to risk again.
Okay, Lord Hill, did you want to come in on this?
So just on this point, do you have or can you construct a route map looking at regulatory issues, how you would start to take steps towards bringing about the change you're talking about? I mean, I happen to agree with everything you've said, but do you have practical proposals as to what that regulatory route map might be that we could start to think about?
We do. I'm very happy to share it with this committee. I do think it starts off across the three levels of government. Government having a more open discussion about why investing is good. For those of us with slightly longer memories, the Tell Sid campaign actually started to equitise UK society, and we saw record high levels of equity participation during that period. I think as a new government, this government has an opportunity to reset the national conversation about getting involved in one's own finances. I won't keep talking about the US, but other jurisdictions take it far more seriously than we do. So having that policy narrative would be a good start. Secondly, with the regulator, thinking how we work with the regulator to do things that mean that as regulated companies, we can take a step forward to address issues such as advice guidance, to move on with targeted support. I mean, these are things that have taken an age, and so it's right that we start to call out pace of regulatory change. Thirdly, I think the ISA regime. Okay, the ISA regime is ripe for simplification. There are, so many multiples of ISA variants. I think people have lost sight over them. And I think what we really need to do is return to a situation where we have a very simple investment ISA, which has levels that rise every year, and perhaps a cash ISA, where levels are below. Some of you may remember the PEPS and TESA regime, which actually encourage long-term investing. And then we can talk about financial literacy, building financial resilience, having not a disclosure regime, but an engagement regime. Disclosure is a staid, arid process of legal protections that's built up because of regulation. We need an engagement regime that starts inviting people to the party.
Ernest Donaghy.
Good morning. Just following on from that, we've heard from witnesses that it's more appropriate to deal with risk appetite on a granular basis, and that the threshold of high net worth investor is set too low at £250,000. What products should fall within the scope of this exemption? Do you agree that there should be a cut-off point? And if so, where else could and should the FCA and the government apply a more granular view of who should be exposed to risk? It's a continuation of what you've been saying.
Do you want to start?
I'll start. I'm happy to start. I worry about arbitrary numbers, particularly round numbers that seem to have appeared and don't move for years. From my point of view, I think there's a conversation we should have about, actually, as a global economy, we want sophisticated investors to be investing in the UK, and so maybe looking at different target groups to encourage international investment. That's great. For high net, we need to do more of that. For high net worth, we need to be looking at way beyond characteristics, way beyond just a certain level of finance, because different people experience vulnerability at different stages in their lives. People become more sophisticated as they deal in financial markets. Others don't. But what we should be making greater use of, certainly in the regulatory environment, and these are a couple of themes for me. The first one is our much richer knowledge of behavioural psychology, actually to be helping people engage and develop their levels of sophistication as they go through an investment journey. And secondly, technology. I completely echo what Douglas was saying about, we've only known each other 20 years.
Scottish, yeah.
About the profound difference that tech is going to make and how that will support people at all stages through their investment journey. So I think it's an area that's just entirely ripe for review. And that's before we come on to people talk about simple products, but there are just products that should just be gateway entry-level products into better savings and certainly better investing behaviour.
I mean, technology is going to change this. I mean, the personalisation that should be required under Consumer Duty to actually sort of say 99% of people in the country would think £250,000 is a huge amount of money, and it is. For some people, it's not. But that's very fractional. But £50,000 is a lot of money for most people. So, I think the personalisation that technology will enable distributors to have around their customers, they've already got an obligation to identify vulnerable customers. They should be able to guide people, or at least give them the guardrails as to whether this is the right kind of asset allocation within your portfolio. And I completely agree with Chris in terms of simplification of products. I'm old enough to remember the review that Carol Sargent did for the Bank of England way back in the day, which talked about good housekeeping, seal of approval kind of products, and regulators at the time fell away from that because they thought it was going to be giving advice. But just the product identification as to somebody like you would typically look at the following types of product to invest in, and so on, and I think the regulators got some really good stuff on the website around. I mean, I remember being in a taxi in America, and the young woman who was driving the taxi said, "You work for a bank?" I did at the time. She said, "What should I be investing in? I've got £10,000, and I said, I'm not going to give you investment advice. I'll ask you one question. Do you have any credit card debt? She says, oh, yes, about £35,000. I said, well, can I suggest the best thing you could do is pay down your credit card debt? And that was a revelation. And that's the kind of simple guidance that I think should be generally available in financial education before they start thinking. And then simplified products with a stamp that says that it does what it says on the tin and the pricing structure is fair.
Douglas, you talked in the submission from Aberdeen about the importance of staying with international standards and also the problem of what you call slow policy making. Would you like to just elaborate a bit on those two things?
We should always try and be competitively better. That's not a race to the bottom, but given that the essence of the funds industry in the UK is distributing product internationally, we have to be internationally aligned. In an ideal world, you would have equivalence, but in a world without equivalence, you certainly want to meet the common international standards so that you can distribute around the world. Sorry, I've lost the second part of your question. Was
the issue about what you describe as slow policy making?
I mean, I think in one of your earlier submissions, the committee commented on being given all the consultation papers and admiring how long they were. I kind of think there should be a two-stage process. I mean, when I talk to Nicola and his senior colleagues, they often express a frustration that when we talk to the chairs and the CEOs of your industry, we find great alignment. Then when we get the response to the consultation paper, it's full of caveats and what-ifs, and we need more detailed notes and so on. And that's because the senior folk in the industry are probably not going to respond line to line on a 90 or 120-page consultation. But if you say the direction of travel is to move more to principles as opposed to rules, do you all embrace that? Yes. Then set the team within that framework that's agreed, if you like, at the top of the industry to now find a way of implementing that. Because otherwise, from a bottom up, people get more and more interested in getting really precise rules that they can embed within their systems. Whereas at the top, we're much more comfortable with principles, accepting the fact that there's a much higher duty of accountability, responsibility if you're a principles-based system, because you've got to demonstrate that you can evidence that you've applied the principle, as opposed to a tick box that says I've followed the rules.
You've both mentioned sort of international and global aspects, and I'm just wondering if one of the problems with one of the aspects of competition is the regulatory burden that's applied here, for example, compared to in the US or Europe or Singapore or wherever. And I just wondered if you have any useful sort of international comparators, both in terms of cost, and we've had some slightly alarming numbers given to us by other witnesses about how much more expensive compliance is in this country compared to, for example, the US. If you have any evidence to give us in that respect, but also in terms of not just cost, but in the way the regulation is carried out, that makes it more or less easy to do business here compared to other places.
Well, I mean, the US is always a good and a bad example. It's such. I mean, we are today, in terms of the market capitalization of the UK market, less than 4% of market capitalization of stocks. The US is, depending on how you measure it, somewhere between 65 and 80%. So it's a much bigger market. So you're spreading the costs over many more products. I think that we hold our head up, I think, extraordinarily well in terms of framework and policy. I think our policymakers within the regulators are hugely admired. I think that in terms of when you get into the detail of supervision and application, again, it's a smaller system. I think it's more intrusive than it used to be, and we could argue that's necessarily so, but it's not any more intrusive than Luxembourg. Which really is the regulatory authority for most of the funds that are distributed through Europe and beyond. So you know, our industry benefits from a regulatory barrier to entry. There's no question of that. We also benefit in this country from what I believe, and as an accountant I always find it difficult to say this, the best legal system in the world. So, you know, there are many, many things that are to our advantage in this country. So I think it's, you know, if regulatory compliance is expensive, then part of that is our own fault. I'll come back to what I said earlier, that part of the challenge we have is that the further down the FCA you get and the further down in our own organisations you get, people are far more interested, are really focused on give me as many rules and as many guidance notes as you possibly can that I can hardwire things, because therefore I can do my job without feeling that I might be missing something. And if you've got two levels of an organisation that are both trying to expand the detail of regulation and compliance, that's where the burden comes from. And that's why I think part of the opportunity is to try and elevate that, recognising that the accountability for more senior levels of our industry and that the regulators would be held to account more, but that would be a good thing.
And certainly from our perspective, it's something...
Sorry to interrupt. Just before you leave that point, you are on the international advisory board, I think, of the Singapore Monetary Authority. We've had a lot of comment that the Singapore Monetary Authority is much more embracing, that their approach to they have a concierge service, that they are enforcing high standards and rigorous supervision, but that they trust firms' competences. Is there much that we can learn from the Singapore Monetary Authority?
Yes, I mean, I think we're pretty good too, and as I said, in the policy area. I mean, but I think, you know, people in Singapore recognise that if you make a mistake, the penalties, regulatory penalties, are severe, and therefore people understand that. I think the system is different. Obviously, it's a much smaller market, and they choose the areas of excellence very, very carefully. Obviously, asset management, wealth management is one of them, because they effectively are the host to many international companies running wealth management across Asia. And you know, the advisory board that I'm going to actually in 2 weeks' time, I mean, they get the CEO, chairman of, I don't know, I don't know how they select them, but a dozen or 15 of the largest asset managers, wealth managers, banks, insurance companies, and they basically set exam questions of, these are areas of possible regulatory opportunity. Last year it was largely around carbon tax, carbon border adjustment taxes. You know, how do we become the home for carbon trading for the world? What kind of a regulatory system should we think of? Blockchain, digital assets, tokenization. They think ahead as to what they want to do, and they then put UBS and Allianz and Standard Chartered and so on, and a bunch of others in a room, instead of say, what would you do to guide us? So I think they try and learn, and the Americans as well, try and learn from the best practice around the world in terms of what's coming next, and then build a policy framework to deal with that. We could do that here easily. One other comment before I lose my thought on that. I think one of the things that we don't do well enough in this country is have policymakers, regulators, and the industry in the room at the same time. The regulators talk to policymakers and they say that, you know, people in the industry, you know, don't get it, don't do it right. Regulators talk to the industry and say policymakers don't get it, they want us to do things that are impossible. The industry talks to policymakers and says the regulators are really on our backs. If we could all get in a room together, it would be an awful lot better. Sorry.
And if I could build on that, one of the most successful vehicles, the envy of other parts of the industry, has been Treasury's Asset Management Task Force, because that actually brought together, chaired by the City Minister with senior officials, the head and executive directors of the FCA, and 7 or 8 chief executives from the investment management industry. And that's why it's easy to point back to a track record of success on things like developing the fund tokenization regime for the UK. That was a product of that particular working party. We did 3 months' work caught upon a 3-year lead by Singapore. We've done other work in the area, just published a report on a base case for artificial intelligence, signed off by the regulator. And there's so much to learn from that experience, actually, about the benefits of co-creation, not taking the industry by surprise, and efficiency of process. And I contrast that with something like the development of the long-term asset fund, which it was an investment association product. We championed it, but good heavens, it was basically 3 years of trying to convince policymakers, and particularly regulators, that something as simple as as having a product that wasn't daily priced wouldn't be entirely unique, despite the fact it operates in America, in Germany, across now the EU, in LTIF. In fact, the European Union liked the LTAF so much they're on their second iteration of it, and we're still debating how far we could extend it into retail markets. So there is a cultural point, which is, sorry, it brings me back to your question on regulatory costs. We participate in surveys that look at regulatory costs, and what we always find is different in the UK is it's not just the direct cost of regulation, how much we pay for the FCA. It's costs such as the £74 million that we pay towards the Financial Services Compensation Scheme levy, and that's on the low side. It's the cost of the Financial Ombudsman Service. So it's the panoply of other regulatory costs, plus the fact that the FCA is not our sole regulator. You know, we look at some of our firms are joint regulated with the PRA. There's also the Financial Reporting Council, the CMA that we have to pay attention to. And I mentioned we're managing £2.5 trillion of EU money. And so that means when the European regulators, ESMA for instance, or CSSF in Luxembourg, CBI in Ireland, when they want to do something, that's a cost on our industry as well, because we want to keep on managing that European money. And there is a message there to regulatory authorities about understanding cumulative impact, not just individual actions. And too many of the cost-benefit analysis that we see tend to be focused on, actually, this regulatory change will cost that much. Well, actually, that's fine, but we're digesting 7, 8 others at the same time as well. I have a list of the current regulatory requirements that our firms are trying to digest. Any one of them, you'd say, well, that would take an entire board meeting to discuss, and there are 7 of them. And by the way, you want to do something on innovation and improve your level of service. The regulatory burden at the moment, I worry, crowds out the discussions that we want to have, and that sense of direction. But I do support what Douglas said.
Donald Douglas.
I'm never going to hear the end of this. I'm never going to hear the end. About the fact that having a point of view and an alignment between policymakers and regulators and industry to get things done is entirely achievable, and jurisdictions that do it well are the ones who are going to be winning in future.
The other thing about Singapore is it's got a central provident fund, it's got mandatory savings, so therefore you've got a vehicle to direct where allocations go, and I think that's Canada, Australia, Singapore, Hong Kong, mandatory savings schemes are a very valuable thing if you're trying to work out how you want to run a savings industry.
And if you split it down between authorisation, supervision, policy and enforcement, any one of those you could say, well, look at the cost compared to other jurisdictions. The cost of becoming an authorised person in the UK, and if you're arriving from the US where you've been running a major firm, why does the FCA can take you up to 6 months to be authorised as a senior individual, an approved person? We look at fund authorisations. Fund authorisations, there are service standards of 3 or 6 months, compared to other jurisdictions where it's 48 hours. So there are hidden costs. I mean, we're doing SDR at the moment, the Sustainability Disclosure Regime rules, where we're having firms who've been offering, can I say, green funds, sustainable, responsible funds for the last 20, 30 years, trying to get a label in the FCA regime, who are now onto their 2nd, 3rd attempt at trying to get a label, and still being rejected. Now, is that a regulatory cost? Absolutely. Does it go into a cost-benefit analysis? No, but it's a cost to the firm. It's a drag on our international standing as the global investment management centre, particularly when the EU is modernising, improving its SFDR regime. So, sorry, complex set of questions.
It is, and I won't ask any more because I'm conscious of time, but just if you have any sort of hard evidence or statistics about how we compare on some of these things, that would be really helpful to receive later.
Lord Grabner, do you want to come in?
Lord Chairman, just following on what you've just been saying, which I must say I found extremely interesting. If we had a clean piece of paper and we were looking at this thing sort of de novo and to try to create an appropriate regulatory structure, would your recommendation be that we should have a single regulator to deal with the whole of our financial services? I mean, my sense from what you're saying is that the presence of two substantial separate regulators is not actually helping matters.
I think that the regulatory environment that we're in today is rather complex because no firm is regulated by a single entity, given the FRC, role and remit, the other regulatory bodies around. What that does bring in terms of benefits and advantage is that the quality of people we normally deal with in the regulators is quite high, and what we always try and get is an alignment of standards between regulators. Sometimes it's bloody hard, actually. But that's what we're trying to do.
We were looking for a yes or no answer.
Heart and head. I think trying to resculpt the regulatory environment at the moment, we'd have to look at the delta as to what the level of improvement would be, and I think it's case and point for a worthy thesis.
I think that my question is really, do you think the presence of the two regulators makes your life more complicated, unnecessarily complicated, more expensive, and could that be diminished or reduced or avoided if you were facing up to one regulator?
So my current experience, even dealing with one regulator in the FCA, is where we're dealing with the investment management team in the FCA, people who understand the depth of the market, we have a very good, very constructive relationship. Where we're even just going across the FCA in areas such as SDR or consumer duty, we already find that people don't understand the technicalities, how the fund management industry works. If we were trying to do that across an even bigger regulator, I'd be worried that actually we would get less attention and that would make our life difficult. But I am all for simplicity.
Can I make an observation that usually gets me into trouble? I mean, there's a conflict between a prudential regulator and a conduct regulator, and it's an interesting one in the sense that a prudential regulator actually wants the firms that it regulates to be highly profitable and investable. One of the things that I think our regulatory framework, taking the two together, should reflect on is why do our firms across the industry trade at a discount to their international peers, particularly the US, because that makes them less investable, which means that the public purse is more at risk in a systemic event than it would be if they were profitable. So if you look at the financial crisis, the Canadians, the Australians, the Hong Kong and Singapore had a very good financial crisis because the firms were very profitable and therefore they were recapitalized from private funds. America, here, Europe, there were bailouts that were necessitated. So if you've got a consumer regulator that's trying to act in the best interest in consumer and keep costs down, which is perfectly legitimate and appropriate, and a prudential regulator that's saying, I need these firms to be profitable so that they can recapitalize in the event of something going wrong, there's a bit of a tension. And finding that balance is a public policy goal. You've also got within the FCA two competing streams of regulation. One is market integrity and looking after the big guys. So you've got the Prus and the HSBCs and Barclays, and you've got the 40-odd thousand IFAs, which is a very different set of skills managed on a kind of a collective data basis as opposed to on a relationship management basis. So there are kind of three streams already within two regulators.
Lord Hill.
I think I'll stick in the same area as Lord Grabner raised, really, which is, so you've said that the idea of doing a complete structural change on the patient when they're still alive, probably not the right way to go. But you're clear that there's quite a lot of confusion, overlap, duplication both within the regulators and between the regulators. So short of something structural, do you have thoughts as to how one could improve the current situation and where we could all be clearer where the boundaries are so that your members or you as Aberdeen aren't being double regulated? So how could one simplify it if we're not going to replace it?
There have been a number of steps that the industry has applauded. So, for instance, there is an MOU between the pensions regulator and the FCA, looking at how they jointly, separately regulate the pensions market. I think there's a bigger question there still to ask about, actually, does that conjunction make sense, or is there a more elegant solution, particularly given the need for the UK to actually address pension poverty and build on the great success of auto-enrolment? I think there is a hanging question over that one. There are, interestingly, some people who work for both FCA and the PRA in the data space, and so there are, and they have a joint committee on data collection these days. So I can see bold and brave attempts to make sure that a firm regulated by the PRA and FCA isn't asked for almost the same but slightly different data, because if it's slightly different, it may as well be totally different because you've got to run it and getting the timing right and so on. So I think there are some really dull technical solutions that could actually bring the regulators close together. The regulatory initiatives grid was supposed to be the air traffic control system overseen by Treasury, that meant that the regulatory authorities would publish in one place a view of all the consultations and so on that they were going to bring to market, and actually Treasury would provide air traffic control so there weren't too many. Sadly, I think that's actually just become a listing exercise, and then we have things like the enforcement consultation from the FCA that don't even appear on it. And so I think that as a structure, it just needs to be load-bearing, and it really isn't. I actually think the FCA and PRA need to have a better understanding of the lived experience of a regulated firm, coping with consultations, policy statements, Dear CEO letters, speeches, the plethora of regulatory tools that are now used by the regulators, and just how firms scan for those, and then what they have to do, as well as digesting the previous three sets of culture change, because it's consumer duty, label change, and so on, that the FCA is already asking of us. There needs to be more experience of what it's like to be running a firm in that type of environment, which is why we're much more positive about secondments both ways and so on, to help people understand what it's like to be a regulator, but also what it's like to be just running a firm these days, and I'm sure we'll come back to that.
But even within a single regulator, particularly the FCA, you've got at the top of the house worrying about the secondary objective and growth. You've got conduct, which is hugely important to market integrity. You've got market integrity itself. You've got the supervision of the way the firm does business, consumer duty, and then you've got a financial resilience team, completely separate, sort of saying it's all very good what they're doing, but what happens if? And how do you prepare for failure? I mean, the amount of time that's spent analysing, what are all the really, really bad things that can happen, and how do you prepare for them? Which is the kind of things that we should be doing and do in stress tests. But in some ways, it's formulaic about a regulatory guidance and what a stress test would look like, as opposed to what do you do yourself to make sure that you are covered in every conceivable or foreseeable circumstance that you can imagine. So even within a single regulator, there's lots of strands pulling in different directions.
Okay. If I may, just on your example of the naming and shaming, which didn't appear on the grid at all. What's your impression of the extent to which the problems some of your members face are driven fundamentally by the regulation, the letter of the law, or it's cultural, behavioural, and you don't quite know what to expect because the behaviour of the regulator might seem a bit willful, and you don't know where it's coming from?
It's a great question because it exposes the multiple parts that firms get exposed to. So there's the policy process that helps set and draft rules and within a wider context. And then there are the interactions with very senior people at the FCA. And I could cite consumer duty as a case in point, where there were multiple occasions where senior people from the FCA would address the investment management industry and say, very little for you to worry about. Very little for you to worry about. Actually, because it's a regulated industry and you have product regulation, very little for you to actually worry about. And then what we saw through the process was an awful lot to worry about, because you'd have to then analyse the speeches, and then you've got actually the interaction with the supervisors. So we have meetings, we have speeches, we've then got the interaction with the supervisors as to what should be going on, and then organisations like mine have to start producing guidance and so on. I can say that in the IA, over the course of since 2022, July 2022, we have spent between 8,000 and 10,000 person hours, the equivalent of 3 FTE plus legal counsel. We've published 9 individual consumer duty publications. We've held over 60 formal meetings. We've got 20 dedicated consumer duty work streams with about 100 members per meeting, and 40 working groups, and answered over 400 member queries since July 2022. A 30-month work programme for an initiative where we were repeatedly told this will not trouble the investment management industry. I hate to see one that does trouble the investment management industry.
Baroness Noakes, sorry.
People having trouble with names today.
I apologise. I'm just conscious of time because I was thinking about Baroness Bowles. I want to try and get, so if the answers could be just a little, I mean, they're great and really helpful, but if you could give a little shot. Baroness Noakes.
I want to come back to the competitiveness and growth objective. And I wonder if you could help me by explaining how the investment management industry contributes to the growth in the UK. And alongside that, what would be the 2 big regulatory changes would help you to contribute more to the growth of the UK?
I think the first one is boundary guidance in terms of advice, because I think RDR was for a particular purpose. I think it restricted pretty straightforward advice to the vast majority of people with average savings of less than £100,000, which again for most people in this country is still a huge amount of money. So I mean, getting a way to give simple advice, I think, would help people understand better what their options were, what the variability of return might be, and start moving some of the money out of cash into.
It would be good for your businesses, but would it be good for UK growth?
Yes, because I think that money that's sitting in cash is effectively losing money for the individual, because it's paying significant. If it's in a bank, it's paying significantly less than inflation, so it's not preserving the spending power. And if that money is part of a pool of savings that is directed towards long-term ambitions, whether it's saving for retirement all the way to saving to pay for a wedding or pay for education, you with a different time horizon, you could make a better return on that money than doing it in cash. And I think if this country is going to build the infrastructure that it needs in terms of transportation and energy and all these other good things, it needs to harness more of the savings pool of the population. So yes, I think getting more of the savings pool out of cash into productive assets. Of course, we've got to find the productive assets as well, or package the assets in a way that would be attractive to the consumer, well packaged and well communicated. Then yes, I think that does help growth in this country.
There are a lot of ifs in that, though, aren't there?
Well, I don't think so. Yes, of course, you can't say just chuck it into infrastructure, it'll be fine. So you've got to design a product, communicate it well. But that's our job. That's what we do.
What's been stopping you?
the inability at the retail end, the inability to give simple advice to people with modest amounts of money.
But you don't have the products already available?
We do, but it's much more difficult to promote them if you can't give simple advice.
And completely concurring with what Douglas just said. As the industry stands today, we're investing £1.4 trillion into the UK economy. If I look at what's going to turn the dial, it's two things. Firstly, it is that reset about the move, recognising that saving is good but investing is better. That actually keeping your money in cash is value destructive. Things like a junior cash ISA guarantees a loss. Investing into an equity fund over the long run is going to deliver a return. If you 10 years ago, if you put £10,000 in a cash ISA, today it's worth £8,500. If you put it into a global equity fund, it's worth £18,500. So, just a really simple message. Cash is for rainy day, investing is for return. So that message. When we talk to our investors in UK small caps, there is a real appetite to be investing more in UK small caps. Of course, we manage money to other people's mandate. Pension schemes will say, we want to allocate X% into the UK economy because that's 4% of the world economy. Don't allocate more than 4%. Allocate the rest globally because that generates a higher return. But when it comes to infrastructure, there is a huge appetite to be investing in UK infrastructure. We're a steady political jurisdiction that is well known for the rule of law. The problem has been a lack of projects, a lack of investable projects, and U-turns on offshore wind, onshore wind, the length of time it takes to get a wind farm connected to the national grid. So there are some policy changes that we would be delighted to see that would really make the difference into how investable the UK looks.
The other thing is financial education. I mean, I'll try and get one of my obsessions in. I think it should be absolutely banned to label, describe DC savings plans as pensions. People in this country say, I've got a pension, and they've got a DC scheme. But in people's minds, a pension is something that pays out an annuity when they retire. They remember their granddad getting one or whatever. Most people coming out of a DC savings plan today are coming out with a pot that's less than £75,000, considerably less. That is not going to look after them in retirement. And yet people say, I've got a pension. They don't. And I think that is one of the worst mislabelings that is common in this country. And that would help.
Only 8% of people in this country get financial advice. If we could get that into double digits, that would motivate money to be invested long term.
Lord Eatwell, you want to come in?
Yes, I want to follow up what Baroness Noakes is asking about the way in which the industry can actually affect growth and investment. And I think there is some real confusion about what you mean by investment. For example, Mr. Cummings just said that UK invests 1.4 trillion, right? That's 40% of UK GDP. Real investment is 17% of UK GDP. So at least 23% of what you're calling investment is not investment. It's buying instruments in secondary markets. And one of the things that strikes me about the financial services in this country is the enormous targeting of investment in secondary markets. The banks have a predominant role in mortgages, and mortgages are houses which are already built. The flow of new houses compared to the overall stock is tiny. And similarly, if we look at large companies in this country, almost none of them draw money from what could be called savings in your terms. Their investments are either funded by retentions or by the bond market, typically. And as Sir Douglas very accurately said, there is this whole problem of the funding of small, medium-sized companies who need equity investment, and the money isn't getting there. So the question I really want to ask is, how do we actually get more of the financial resources in this country targeted at real investment, not the secondary market, but actually the primary market, I don't know whether it's IPOs or equity funding for small and mediums, or perhaps equity funding in infrastructure, I don't know. But how do we actually get funds into real investment and not confuse investment with buying already existing instruments, which isn't really investment at all?
Yeah, wow. I mean, there was a very good review done of the primary market challenges that we've got. I mean, I think, as Chris said, one of the things that sometimes is not as understood in the public as it should be is the fact that the asset management industry basically has two jobs. One is to allocate money in accordance with the mandates that's given by its clients, so insurance companies, pension funds, and so on. Sadly, those funds today allocate very little money to investment in small and medium-sized companies. I won't mention the name, but I chair a company that effectively commercializes science out of British universities predominantly. Yeah. It trades at half its market cap, half its net assets, and half. And there is limited appetite for it. And one reason, and it's an issue, is liquidity. I mean, a company with a market cap of £500 million, 10% of that company, most people don't want it in 10% of a company, would be £50 million. Most pension funds don't get out of bed to invest £50 million. So there is a challenge which I think British Business Bank is going to go a long way to address. But part of it is getting mandates that are pointed towards, and again, that's where I think financial education will help, because I do think consumers, if you were said you're investing in UK PLC, people are happy to do that for a return that looks adequate. It doesn't need to be leading in the way that an institutional investor might look at basis points. I mean, if you look at University Superannuation Scheme, which has done extraordinarily well over the last decade, I think you've got to go to its 16th biggest investment to find something in the UK. I mean, it's and yet, if you've got a stewardship requirement, you're looking for return, and the best return over the last decade has been in the United States because it's been in life sciences and technology, and we don't have companies in that space. So part of the challenge is not how we allocate the money, but part of the challenge is how do we create the businesses that will attract the money, rather than how do we point them towards businesses that don't attract the money because they're not seen to be as good as opportunities elsewhere.
The issue is which is cause and which is effect.
Well, it's both. Yeah. It's both, and part of it's something not in this committee, but I mean part of it also is that MiFID lost us the ability to host research in this country in the way that was done before MiFID, because it was bundled, and whether that was right or wrong, but it did facilitate a lot more research on smaller companies that simply doesn't exist today. But we've got to do something to create a pool of money that's pointed towards small and medium-sized companies in this country, because they do tend to be domestic, and they do tend to support our science base.
And I suppose you wanted to come in on this.
Yes, well, I think it fits in very well here, in that one of the sectors that until a couple of years or so ago was actually doing very well in terms of investment into the real economy was the alternative sector of investment trusts, which was investing in renewables, small companies, social buildings and things like that. But then we've had the issue with investment trusts and the so-called cost disclosures problems, which is not about whether to report costs, it's about how to report them. And we got to what we thought was the happy situation in September, with the government issuing a draft statutory instrument and the FCA issuing forbearance, so that the complexities that had occurred due to EU legislation could be set aside. But then, and I have to address this to you, Mr. Cummings, now that all happened in September with the additional clarification from the FCA that it had applied throughout the chain down to the manufacturers, the distributors, and you know, retail platforms and everything. Then on the 11th of October, you held a members' meeting and presented a slide from a pack that summarised the new FCA forbearance, saying that manufacturers and distributors are no longer required to prepare, publish or provide a PRIP KID for an investment trust, that investment firms are no longer required to aggregate the costs of investment trusts as part of their MiFID cost disclosures. But then you went on to say the FCA position is that investment trust costs are misrepresented under MiFID and PRIPS, but they are not zero, as per Nikhil Rassi, the Treasury Committee oral evidence of the 8th of May 2024. And therefore, in our view, that is the IA's view, manufacturers need to provide an appropriate number for MiFID ongoing costs in the EMT and the PRIP KID, that being the PRIP KID that's no longer required, and the PRIP KID, and that number is not zero. And I'd just like you to explain to me how you think something said by the CEO of the FCA on the 8th of May somehow overrides what the government and the FCA did in September.
Well, thank you for the question, the opportunity to set out our view, which I see you've circulated a slide that was from a meeting of our members, which was held on the basis of discussing what the IA's position should be. So this wasn't a conclusion, this was a point of view for discussion and then agreement by members. And I'd like to pause on that because I think it's really important to understand that the slide in front of the committee was not the conclusion presented to members. It was for discussion to hear what members wanted us to do in that point of view. As the representative body, we're concerned with a number of things. The first one is that retail investors should be entirely clear about the costs of investing. That's hugely important. That goes to the fundamental of our industry. If people aren't absolutely clear about the costs of investing, why on earth would they? We had a situation implemented across the UK because of the PRIPS regime, which was wholly unsatisfactory. And I'm on record multiple times for calling for the PRIPS regime to be urgently reviewed for all investment products, because it led to aggregation of costs that were simply misleading. You could trade in capital markets and actually get paid for it, apparently.
We've discussed all this on the committee.
Well, no, but forgive me. You're presenting a slide to me. I've only just seen it. I'm trying to give the background because I think that is really important for the committee and actually the wider audience to understand that what we were trying to do is achieve a principle, which is how do we help retail investors understand what they're actually paying for. The FCA regime under PRIPS was deeply flawed, and then added to that we had MiFID as well, and actually the two regimes didn't line up. And this is again one of the multiple occasions where as a representative body for the industry, we try and find a way to make sure our members are the right side of regulation, despite the fact that there are two fundamentally contradictory things in the market. And I'd suggest you look at consumer duty fair value assessment, backward-looking with value for money assessment, forward-looking as another case in point of a lack of systems thinking. The Treasury, forgive me, I'm coming to it.
I do need to get on to the consequences.
Forgive me. The Treasury forbearance statement, the FCA forbearance statement arrived with a bold statement and no supporting notes or guidance. The first question we were asked by members who I would call manufacturers and then separately by distributors was, this looks like it only applies to the aggregation, not to the product cost. And we heard that multiple times. What do we do about the product cost? And so what we found in the market was that many firms, particularly large firms, were producing two sets of disclosure documents. One that was a KID, that said costs are zero. Entry costs, management costs, exit costs, zero. Asterisks, please see our terms and conditions, please see our statement of expenses, which then listed out a whole set of costs. Now, if I'm a retail customer and I'm dealing with a firm that tries to tell me that something is free and has costs, I'm sorry, a now you see it, now you don't disclosure regime does not work.
Well, can I then...
So what we were trying to do on this
Can you just let Baroness Bowles come back? Yeah.
Forgive me.
Because I'm very conscious of time. Yeah.
I think so. I mean, you can talk it out, but I'd like to get on to what the customer sees when they go to a retail platform now. So if you go on to Hargreaves Lansdowne, for example, and you clock up, I'll actually choose Oakley Capital Investments Limited. It's not a slide that everybody's got in front of them, but I can say, and you look at the how much does it, click on how much does it cost, and then you click again on investment charges, and you'll see net initial charge, 0, that's fair enough. Then net ongoing charge, 2.69%. This is a venture capital fund, so it will be quite expensive. So that gives you £618 odd. Then it says incidental charges, and there's another 1,000 there. And then nothing for transaction costs, it has stamp duty. So then gives you this total charges over 5 years of £1,827, and tells you that if you had an investment of £5,000 growing at 5% per annum, your net result after this is going to be £4,306. So you're going to make a loss. So they're not going to buy it, are they? But if you actually look at it, what is this net ongoing charge? Well, that's £618 paid by the company that is already incorporated into the share price. So that's not a charge that's coming off the investment that is held by the investor. Now let's look at incidental charges. This is quite interesting because if you know your MiFID or Greg, which I do, incidental charges is performance fees. And so they're saying there's going to be these performance fees coming off. Now that's quite interesting because for Oakley Capital Investments, performance fees don't click in until 8%, and this is a projection based on 5%. So there's a bogus 1,055 coming off, and then so you know it goes on. So you're saying that this is better than saying 0 in the EMT, when you'll actually get to something near the true figure at the bottom. So, and if you go to a company that has done that, a company such as, let me see what I've got here, GCP Infrastructure Investments, you know, just the sort of capital investment that we are supposed to want to have in all kinds of things in the country. So this has got zeros in there, and it tells you for your £5,000, your illustrative 5-year value is going to be £6,212, which is a lot nearer to the truth of the matter because all of the costs are inside the company. But if you want to buy this and you click on buy, then you'll get the message, this stock is currently unavailable to buy. Regulation requires HL to display information about costs and charges, which incidentally they have, but we don't have access to this information at the moment. Actually, what they don't have access to is information that they say they want that is not what is the truth. And you can hold or sell existing shares, but you can't currently buy more. And we're sorry for any inconvenience. Now, as I understand it, at the meeting that you held after presenting your slide 8 and saying, does everybody agree, which there was sort of not disagreement amongst the sort of 50-odd participating members, there was also a presentation by Hargreaves Lansdowne saying that how platforms would block retail access if you put 0 in. So when you get the truth of what your investment might be worth of some 6,000, you're blocked from buying it. Actually, if you phone them up and say, why can't I buy it? They'll say, oh, well, if you buy it over telephone dealing at a vast greater commission, you can actually buy it. So that's a nice little wheeze, isn't it? So how do you justify that it's better to block access to that truth and you want them to continue with the sort of nonsense that I've just read out about Oakley Capital?
I think you've explained the situation wonderfully, which is that we had a flawed disclosure regime under PRIPS that put into the market.
We know all about that, but
figures.
You've got the solution. The government and the FCA have done everything they can within their powers, because the FCA can't do anything other than say, right, as far as we're concerned, that legislation doesn't exist. There's forbearance. The government said it's taken away, but the statutory instrument hasn't gone through yet. But you're saying, no, we want to go back to the old version.
No. Forgive me. We are absolutely and fundamentally not saying that we want to go back to the previous regime. Completely not. Our strong advice to policymakers in areas such as this, where there is going to be forbearance, a regulatory change introduced to a market at a moment's notice, is please work with the industry so that we can sort out our computer systems, the advice guidance process, the manufacturing process, so that actually we're able to do what our main job is, which is to help retail investors understand what is going on. Because the way this landed in the market was to cause absolute confusion.
I think the confusion is caused by you, because you've said you're quite happy to have zero when it's in aggregation. So your members, UCITS funds, they can happily use zero, but the retail customer doesn't get to be told that it's zero. So how can you sustain that? And if you actually look at what the retail access is at the moment, if you're a retail platform and you buy an investment trust that's held in a UCITS fund, you're told it's zero, and that's okay, because it's one of your members. But if you go and try and buy it on the platform, well, you're blocked. You can't buy it if it says it's zero. If you go to a business-to-business platform, then they're all happily using zero. And if you force the consumer to go to a more expensive route, they can have it zero. But you're agreeing that you won't let retail customers, at the place where they're most likely to go, to a retail platform, they cannot be told, the nearest that you can get to the truth, if I could put it that way, that it's not coming off their investment. You've agreed with platforms and your members that it's all going to be blocked and they can't have that.
Just for a point of clarity, if I may, our membership includes investment trust companies as well. So
you don't represent investment trusts.
There is an association of investment trust companies who we work very closely with, and we regularly produce joint work. We have a mutual interest in making sure that retail customers... 45
times larger as a sector than the investment trust sector. So you have kind of 45 times the access to the FCA, 45 times access to the media, 45 times the opportunity to put forward your views.
My sincerest wish on this was that the FCA had brought out their consultation on the new disclosure regime ahead of issuing forbearance. We have been talking about...
You want the forbearance to go on as long as possible?
No, forgive me. What I want is a new disclosure regime based on engagement that encourages people to invest. We've got a dip in the market at the moment where part of the market has a forbearance notice that respected companies don't know whether they can stand on that, whether in 5 years' time there'll be complaints brought about them to the Ombudsman because you told me this was zero and now it isn't. There is ambiguity.
Is it not the case that the main quandary for these companies is that the boards of the investment trusts are terrified that they're going to be blocked from the platform? And so they'll continue to put some number in there. It may not be what the old number is. I mean, there's all kinds of interesting numbers going in now. So they're not worried that there are different ways. The AIC has come out with guidance saying, well, it really should be zero. But if, because of my words, the platform's blackmail, you think you've got to have a number in there, you could justify putting these kinds of numbers in as reasonably informative, but less than the overall giant number that you had to put in before. Is that satisfactory?
I think the previous numbers were very misleading, and we are glad that the FCA has finally seized the initiative to have a review after much industry campaigning to say the disclosure regime simply doesn't work. What we want to get to is a disclosure regime at pace that takes care of the whole market. And no investment platform is going to deprive its investors, its customers, of products that they want. So I can't speak for the AIC, but I would like to think that between
the platforms are blocking, or they're not putting up the newest information, but then they will sell it to you if you go and pay a higher fee.
I have no knowledge of that, apart from what you say. But I think
don't you do mystery shopping?
Forgive me. All I would like to say is that between ourselves and the AIC, I would hope there is a fervent agreement that we need a disclosure regime which separates the difference between some costs and value.
Okay. I don't think Baroness Bowles is convinced.
And I would be very happy to meet with Baroness Bowles afterwards. Yeah, I think this is becoming an issue that we just need to work our way through.
Yeah, and I think it's an important issue, and it's one that the committee are concerned about. So perhaps we can continue this discussion in correspondence with the committee, because I'm very conscious of time. Sorry, did you want to say something, Lord Lee?
No, I'd take up the idea of a meeting, I would have thought.
Yeah, yes.
With pleasure.
Right. Well, I should put your armour on. Lord Kestenbaum.
I have a question which relates again to the regulator's ability to enable that secondary objective of growth. And in particular, a kind of two-tier system which we've heard from one or two people, and Mr. Cummings, you may have something to say about this, insofar as the larger firms, kinds of firms that, Sir Douglas, you're so familiar with, both in terms of their ability to resource for the compliance burden and a kind of cultural understanding that the regulator has of them and with them, are in a very, very different position to the smaller firms, let alone the startups that we've all spoken about, who self-evidently are less able to resource their compliance departments, but much more significantly, and we've heard it from one or two witnesses, there seems to be a sense that the regulator really doesn't get the kind of growth trajectory of the smaller firms. And therefore I wonder if you might have something to say about this, a picture of a kind of two-tier system which seems to be emerging.
I think it's an area that's worthy of examination. I mean, I think that there are a number of technology solutions in terms of compliance that enable small firms to digitize, if you like, the compliance burden as long as they stick with simple products. I mean, the biggest burden in our industry is know your customer so that you can identify vulnerability and place them in the right category for what kind of investments they should be able to access. I would push back a little bit and say that the reputational risk that we do not want to bear as an industry is a small but highly publicized number of small firms doing bad things, and therefore, because the media does tend to write more extensively about failure than it does of success, and then people get in their mind that this is an industry that we should be cautious about, and you end up with getting risk aversion. So I think as I said earlier, I think at the governance level, there shouldn't be a two-tier system for small and large firms. There should be a system that says you have to have the appropriate governance systems in place to be able to take money from the public, to invest money on behalf of the public. And if you're a small firm, you shouldn't be doing the very complicated things unless it is the only thing you do and you build a disclosure and a compliance system. And some of the small firms that only do one thing, very, very complicated specialized things, have some of the leading experts in that area because it's all that they do. But to try and be all things to everybody as a small firm with 20 employees, I think that's my view. That's not the kind of competition that we want to see. Not because it's against our own self-interest. It's because I think the public interest means that there has to be a fairly high bar for admission.
So from our perspective, we want to see a really rich ecosystem of firms operating in the UK, because that's part of the health of the ecosystem that we have, to the point where we regularly run trade and investment programs to other parts of the world to advertise what a welcoming jurisdiction the UK is if you want to set up a new investment management firm here. And with some success, the UK actually tells a better story normally when regulators and businesses are outside of the UK. I would be troubled if all we saw was an agglomeration of firms getting larger and larger, and I think that's because of the cost of regulation. That's a clear market trend that we're seeing, and I think that should be a worry to everybody, because of the greater consumer choice means better competition in the marketplace, and actually as investors we get a better deal. I think the FCA is aware of that. There's a meeting going on in my organisation this very morning where the FCA's head of competition is coming to talk to some of our smaller firms to hear about the lived experience of running a small firm in an environment where just the number of regulatory initiatives can be overwhelming, and how do you keep pace with that? So it's something that we're very alive to, but there is a point about why is the Financial Services Compensation Scheme bill so heavy across financial services. It's because the FCA, in its authorisation process, has let in too many firms that didn't have the financial resources and the non-financial resources to cope, and needs to do a better job of tracking those firms against performance of the business plan that they have to submit to the FCA to get authorised. Because if you're going to say you're going to do X business and you're doing X plus 10, there should be a little amber light going off at the FCA somewhere that says maybe a supervisor should drop by and just make sure everything's okay. So I think there are some approaches that the FCA should experiment more with, but the answer to do it properly has got to be more sophisticated intelligence gathering by the FCA, better use of tech.
Okay, on that note, it's been a very interesting session, and we could go on considerably longer, but we haven't got the time. So could I thank you, Mr. Cummings, and you, Sir Douglas, for coming today. There are a number of questions which we would like to have asked, which we'll send to you, and if you were able to give us a response in writing, that would be much appreciated. So this session is now ending. I'll just remind committee members that the microphones are off, but the cameras are still on. Okay, thank you very much.
Thank you.
Mr. Ranjan, Mr. Taylor, you very kindly were here for the earlier session. You realise why we've gone on a little bit longer than we intended. You heard what I had to say about the transcript and everything else. So we'll go ahead with the session now. Did either of you want to make any kind of opening statement?
Yeah, sure. Yeah.
On then.
Very grateful for the opportunity to present in front of this committee, and look forward to the discussion. I'm Ranjan. I'm co-founder and CEO of Sardine. We are a venture-backed startup based out of the US. I'm personally based out of San Francisco, California. And we today work with about 250 plus financial institutions globally, which includes banks, payment processors, and fintech startups as well. So I'm here to represent my views as well as the views that I have heard from our customers, which span the globe. So really grateful for this opportunity. Samuel?
Echoing Supes' comments, the only thing I'd add is I was head of crypto R&D at Barclays. I also spent some time helping set up their startup outreach program, Barclays Rise and Techstars. So I've worked in a large financial institution. I was also founder of a company called 11FS that worked very early in the fintech ecosystem in the United Kingdom and have been involved in the media side on that as well. So I possibly offer a more UK-centric perspective, but also one that is potentially closer to how some of the startups think and feel here on the ground. And I'm based in London.
Okay, perhaps I could get on with the first question, which is about some fintech firms have been criticised recently for failing to protect consumers, in particular victims of authorised push payment fraud, which relies on social manipulation. And we understand that one of the services is to offer software that monitors transactions, identifies instances of fraud and intercepts these. So what costs are there associated with prevention in addition to compensation? And can you share any data on which types of firms are hardest hit by APP fraud?
Sure. So what I would like to start out by saying is that APP scams are affecting everyone pretty much across the board, so including the large banks as well as fintech startups. And one of the differences, though, between the large banks and the fintech neobanks is that for the large banks, the consumers are using them as the primary bank account, whereas the fintech neobanks are normally the secondary bank account. So which means that fintechs, to begin with, have access to much smaller amount of data in order to detect potential scams and fraud attacks, right? Because with a larger bank, presumably, if you are getting your paycheck in and you know that the consumer has a certain amount or certain type of counterparties that they interact with, then you can presumably make a more educated decision as to when somebody is paying a counterparty, whether that is fraudulent or not, because just on the basis of past association, past history. Whereas for fintechs, they are missing that data. And that brings me to the main point over here, which is that in order to detect fraud, we need to enable information sharing across large banks as well as fintechs, because at the end of the day, fraud should not be thought of as a competitive moat. It should be thought of as something which is a utility, which essentially helps consumers at the end of the day and also helps smaller startups become more competitive in detecting APP scams or fraud. In particular, I would also like to point out that in the current reimbursement regime, which has been proposed by the PSR, there are certain issues which haven't yet been addressed, which also make APP scams harder to detect because, number one, the regulation has taken a stance towards reimbursement instead of actually prevention of scams. What that means then is there are a few things which have not yet been taken into account, which are actually going to affect both banks and fintechs. For example, number one, today the liability is shared 50-50 between the sending bank and the receiving bank. Whereas, it could be argued that if the sending bank has done its share of the work, for prevention, then they should not be held liable, because in the current regime of sharing at 50-50, it kind of makes people not pay as much attention. The receiving bank may not pay as much attention into the prevention. And secondly, because it's being shared 50-50, what might also happen is that once the money has left the sending bank, the receiving bank does not, because they're also being held liable, they're actually going to hold on to the funds for far longer. They're actually going to hold on to the funds for up to 3 days, which has been prescribed, which essentially means that faster payment systems could essentially come to a halt. It could slow down immensely. The second point I want to make is that the reimbursement model also defines gross negligence in a confusing way right now, because it's unclear whether a payment service provider may ever win a gross negligence case. A gross negligence case here meaning if a consumer has been given enough warnings that they are being scammed and they still go on with that payment, then I would argue that, on behalf of the industry, that the sending bank in this case should not be held liable, right? Because they have done enough, right? And for that also, the third point that I would like to point out is that the liability period is 13 months right now, which means that the sending banks as well as the receiving banks have to hold it in the capital reserves, basically all the A2A or the faster payment or CHAPS transfers for up to a 13 months period, because all of that could be clawed back. And in contrast to the rest of the world, that period is very long, because if you contrast it with the US system for ACH, the liability window is 60 days for retail and 3 days for commercial transactions.
ACH?
ACH, yeah.
It would be like backs.
All right, okay.
Yeah. And secondly, for card payments as well, the liability window is 6 months. So therefore, I would argue that the 13 months makes it very less competitive.
Lord Bull, this is your special subject.
So just on this, I mean, the reason for the reimbursement regime is to try to create an incentive for the banks to prevent fraud. That's why it's there. It's not actually an either-or. It's there. It's designed to try and encourage the banks to take the steps to make sure that the fraud doesn't happen in the first place. And the reason it's targeted at the banks is because all fraud ultimately has to go through the banking system one way or the other. So that's the touch point that every single fraud has. That said, I absolutely agree with your point that I've always felt that the receiving bank should perhaps be more the target than the sending bank, if the sending bank has taken appropriate steps to identify. So I do get that point. But the fraud environment is much wider than that, and there's a whole chain from where the fraud begins to where the money finally ends up and gets cashed out. Do you think we've got the incentives right for the rest of the fraud chain? And if not, how could you do it to make sure that they do their bit within to prevent the fraud arising in the first place?
Yeah, so I would argue that, to your point, the reimbursement scheme is great because it does protect consumers. However, one of the biggest things that is missing right now is lack of coordination between the financial services sector and other sectors, which is referred to as polluting sector, which is social media companies and telcos. Because a vast majority of those scams, based on our conversations with our customers and other parties, they are originating from either social media forums or they are originating because of a phishing attack which started from a text message or a voice call. And if you look at what, for example, Singapore has done, right? They have essentially created an ecosystem where banks, telcos, and social media companies as well can share information together. For example, before you initiate an SMS message in Singapore, you have to be registered with a caller ID. Secondly, only registered aggregators are allowed to originate SMS messages. Thirdly, telcos have to take measures to call out scams which are being perpetrated via their networks, right? So those things are still missing in the UK, and that I would like to point out.
And there's a bit of a gap, if I may add, between the sort of fraud campaign that's been happening funded by UK government, the Online Safety Act, and some of the work that came out of the Online Safety Act and DSAT, and the work of Ofcom, and of course then the PSR liability scheme. All of these things sort of cut across fraud and scams in some way, but it's particularly disjointed, and there's an opportunity there, I think, to think about how that impacts larger and smaller firms. So that would be point number one. And point number two is data sharing, as Soup's raised, is a very the devil is in the details issue. There are lots of initiatives to share data that are available. So open banking has an optional standard called TRI, the Transaction Risk Indicator, that would, if used, potentially send any risk related to a payment through an existing regulated channel. However, it's optional. So most of the banks choose not to use it because it might be an additional work and additional expense. So there is that channel. There is an initiative by Pay UK for enhanced fraud data. But we see there's a need for real momentum. And that data sharing, again, a lot of that conversation is driven by those who can afford to put people in the room to have the conversation, the larger institutions, and is poorly represented by smaller organisations, despite the good work of some trade bodies attempting to level that out. So I do think that the data sharing piece, there are pieces we can do within financial services, but a lot of what's coming out of the online platforms is you give us your data and we'll tell you if we think it's a scam, rather than we will share data on a more equitable basis. So I think the opportunity for good coordination there is vast.
The data thing is interesting. The excuse that's usually used is, oh, we can't provide this sort of data because of GDPR.
Yeah.
Do you have any views on that?
Absolutely, yeah. I think there is definitely technology that exists to allow for data sharing in a privacy-preserving way. Mm-hmm. But that'll be the first point I would like to make. And secondly, we at Sardine, we have built the entire company on the model of essentially data sharing, because we have a consortium machine learning model, which right now comprises 2 billion devices, 160 million customer identities tied to those devices. And that benefits everyone, right? And we strongly think that, in this case, for example, if we were to bring the big tech companies like Google and Meta into a data sharing agreement, there are several things that can be done where even PII data does not need to be gathered. For example, I'd like to share like a common tactic that fraudsters use today, right? So oftentimes, before a scam starts, a scammer is going to chat with hundreds of victims. I'm sure all of you probably get like these these text messages which are not really meant for you, right? So what the scammers are doing is that, do you think they're typing those messages themselves? They're not. More often than not, they have jerry-rigged a device farm where all the, like I have videos where the devices are actually lying flat on the table, right? And then they're using a software to actually make the chat conversation on Instagram or, other forums. Now, if you think about it for a moment, when, let's say, I receive a text message, if only I could know that that text message came from a bot, which was not typing directly, it was typing but the phone was face down. That in itself is not a PII signal. And that alone could provide everyone in the ecosystem enough evidence saying that, hey, Soups, you're chatting with a potential scammer, and therefore any other subsequent activity that you undertake, which could be financial in nature, please be forewarned that this is a scam.
What do the ICO should be doing to clarify the data rules there?
It would be helpful, I suspect. I have no specific immediate examples that I could give, but my experience of the culture of financial services, having worked with and consulted to them is everything's hard if it involves data, because it is, but that doesn't mean we shouldn't do it. And of course we have lots of precedent for sharing data when it comes to anti-money laundering and dealing with fraud. CIFAS, National CIRA, the Hunter database, there are many of such examples that are live and in production, shared with law enforcement on a regular basis. This is absolutely achievable, and it has been helpful in my experience to not only create that clarity at the regulatory level, but to engage in participatory roundtables and discussions where that clarity is built upon in conversation with the industry. I think that would be particularly helpful. And whether that's a Dear CEO letter or whatever else it needs to be is up for smarter people than me to decide.
Lord Gravener.
I've just got one question, if I may. You're both, I think, experienced with digital assets, is that right? And the point I'm interested in is the volatility, in particular, of the Bitcoin market. I think overnight, with the American election results, the price has gone to 75,000 or something. I just had a quick look on the phone, and that's what it said. That volatility is potentially extremely damaging to consumers, most of whom, or a very large number of whom, are attracted by the prospect of an immediate profit, but based upon complete ignorance. At the moment, as I understand it, none of this is regulated. What do you think about that?
Yeah, I'm happy to take a first shot at it. So I do agree with you that the volatility could actually hurt customers as well. One method of potentially regulating crypto could be to think of it as any asset which has a lot of volatility. For example, you could think of regulating it like gambling, right?
That's exactly what it is.
Yep, that's right. And personally, when I speak with my friends who are interested in crypto, the advice I give them is only invest the money that you're not afraid to lose completely, right? And in that regards, it's very much like gambling. And right now, the fact that it's not
Your friends have got access to you, but I mean, what about somebody who doesn't know you and is just very attracted by the headline in the morning newspaper?
That's an issue.
Shouldn't they be protected by regulators or by regulatory structure?
I 100% agree with you, and they should be protected by regulation.
Why aren't they, do you know?
So in different countries, because regulation often lags behind technology. So that is what we are seeing has happened. Regulators are still not able to comprehend in lots of jurisdictions, for example, outside the US, whether crypto is a security or a utility or something else, right?
If I may, Soups, I think the FCA has done a commendable job clarifying the nature of what a crypto asset is for the benefit of the UK population. There's been good work clarifying the online promotions section of the FCA handbook. There is now a register of crypto asset firms held at the FCA. It's rather unfortunate that the crypto industry is also very correlated with the scamming industry. It has a very negative reputation. As somebody who has worked in financial services for a very long time, has worked in payments change for a long time, I remain a massive fan of the technology. Digital assets themselves, when properly regulated and when properly packaged and properly disclosed, and not sold as a speculative asset, but rather used for payments, used by regulated institutions, could be transformative. And I recognize the good work of the APPG blockchain in producing a lot of good insight into a lot of that work. Volatility is something, to the previous conversation, that again probably comes back to some level of disclosures, and we need to make sure that is continued to be focused on. My understanding is that the online promotions, forgive me, I'm not familiar with the exact act, whether it's the regime, has been clarified quite clearly, and that there is also a direct licensing regime from the Financial Conduct Authority for any firm that is offering these types of products, crypto assets, to UK consumers. They must be licensed by the FCA. So to some extent, despite their risk, they are in fact regulated. But perhaps, and I would put to you, that should be an ongoing conversation. We should continue to evolve that conversation, and where there are consumer harms, we should be directly addressing that.
Lord Lilly?
Lord Chairman, you have given very concrete and detailed answers so far, which is very refreshing. If I were in your position, I would have come here before a committee considering financial regulation with 2 or 3 changes I want in financial regulation, either specific rules changed or ways that the regulator operates. I suspect you're the sort of person that people would have come with those 2 or 3 ideas. What are they?
Great question. I would simplify it as, number one, the coordination of the financial services regulators with non-financial services regulator. Number 2 would be the encouragement for data sharing between larger and smaller firms and non-financial firms. In whatever way the committee deems appropriate for that, I don't have a direct policy answer for what that should be. Number 3, the encouragement of standards for that data sharing. I'm rather concerned about the lack of technical knowledge that goes into standards development from the policy side. I would point you to the open banking implementation entity and the difficulties that the industry had getting to open banking standards. It took many, many years. And of course, the larger institutions had the largest voice and the smaller organizations complain of lack of access. So where data sharing is promoted, it must be done so in a way where there is a tech-led approach and a tech-savvy regulator and a tech-savvy policy voice within the room, and that would make a meaningful difference to the issue of APP fraud, mule activity, and other activities as well. There are other questions in here, and I can pause there and take direct thoughts towards how we make the UK more competitive on the global stage and what metrics we should look at. And I can dive into those if that's helpful, but I thought I'd give you the higher view.
We'll get those questions specifically from my colleague.
Was that helpful?
They're very helpful.
Yeah, to add to what Simon just said, I think two points I would like to make. Number one is regulators should embrace new technologies, right? Yeah. So right now, even before AI existed, the questions that financial service companies used to get used to be about machine learning. And now that AI is here, regulators are probably thinking about how should banks adopt AI technologies. And in that regards, I don't think there is a full clarity as to what are you allowed to do with AI and what are you not allowed to do with AI. For example, with machine learning, the regulatory questions that we often get is are your machine learning models explainable? Right? Are they a black box? So those types of questions, now that there is technology which can explain machine learning models pretty adequately. Now, so moving on to AI, what would be helpful is, if regulators could explain things like, yeah, it is okay for the bank to have AI models which, for example, do things like populate a SAR narrative, which, by the way, is a piece of technology we have developed at Sardine. But what is not clear is, if I am submitting that SAR, could I submit that SAR directly with suspicious activity reports? Yeah. Could I submit the suspicious activity reports directly with the FIU, or do I have to have it be reviewed by a human? Because what we have seen is that once you start using technology like AI, you can actually improve the efficiency of compliance professionals by 5 orders of magnitude or even more. And in that regards, it directly correlates with reducing the cost of doing business for banks. So therefore, what I would argue is that regulators should enable and actually, really help banks adopt newer technologies. And then the second point I would like to make, which is particular to APP scams, and just elaborating on what Simon said, regulators could also embrace public-private sector partnerships much more. For example, with the efforts that Simon mentioned around data sharing, which have been proposed by the public bodies here in the UK, what our conversations have revealed while talking with fintechs is that not many of them have adopted those data sharing technologies because they're not at par with what the industry is looking for. So therefore, instead of the regulator playing the active technologist role, what I would argue they should do is they should essentially invite industry to come and run those systems, run those data sharing systems in partnership with the public sector, because that would be a net win-win for the entire industry.
Lord Hill, did you want to come on?
This is a small follow-up to Lord Lilly's question. So you're not regulated but by the financial service regulators, but what you do is very affected by regulation. Has the FCA ever come and talked to you and asked to give your advice and experience on how their regulation is affecting our ability to deal with APP fraud? Do they ever talk to you?
No, not yet.
Okay, thank you.
Yeah. We have had conversations in the US with the regulators over there, with the OCC, with the FDIC and others, but not in the UK, not yet.
In a prior life, many times, I found when I worked at a large bank and I was head of crypto asset R&D and digital asset R&D, I found myself spending a lot of time with the regulators.
Not as a small
but not as
guy.
a smaller firm. However, if I was a smaller regulated firm, then it's fundamentally different. Yeah. But as a technology supplier, not very little. I should mention, though, however, that in a private capacity, I have had some less formal interactions, but not through the company.
And I suppose, Lord Eadwell?
Yes, thank you. Could I ask about the responsibility of the customer, if any, in all this, and especially in what turns out to be fraudulent transactions? The technology you've been talking about to combat fraud already exists to some extent. When it's deployed, at what point might it be reasonable to recognise that consumers have been suitably informed, and therefore they're at least partly responsible for the transaction?
If I could give you a worked example of what I think best practice tends to look like in terms of informing consumers. So one of the downsides of being a sort of a younger technology company who's a secondary account is you don't have as much data, so you have to find other ways to prevent fraud. And so you do see some prevention best practices that are exceptional. One example I would point you to is Monzo. They have an active call-in session flag in their mobile app. So if somebody calls you and says, hello, I'm from your bank, I'm here to take all of your money, you can go into your mobile app and check, am I really on the phone with this bank? And they've secured that link. That is a positive development that technology could also do, and I would like to see that go throughout the industry. Another best practice from a consumer responsibility standpoint then would be if they still wish to make a payment, you then play a small video, an educational video. You then maybe make them wait for 3 hours. So it's not just a single simple warning. It is taking them through wait periods. It's doing everything you can using the technology itself to try and break the spell of the scammer. And once you've done that, after 3 hours, after you've had time to think about it, time to cool down, you still want to break the glass and move the money. At that point, you've got to be really sure that you want to move the money. And it is very much the case that people will still be legitimately and genuinely defrauded, and there will still be legitimate and genuine scams against the vulnerable populations.
What is a legitimate scam?
Well, there is a broader issue, which is first-party fraud. A lot of people will say, sorry, I've been scammed. And that's first-party fraud makes up a vast majority of fraud, which is chances. People buying a product and saying, oh, the goods were never received. So that is kind of an illegitimate reporting of fraud because it is first-party fraud.
It's still fraud, surely.
Yes, it is. But the customer is saying, I was defrauded, when actually they were the fraudster.
Friendly fraud.
But that's interesting. But the point of my question was, is there a point at which the consumer, the customer, has to take some responsibility for the subsequent fraud?
I apologise. I took us down a rabbit hole and used an incorrect definition, which one should never do in the House of Lords. So, yes, I would argue. I would argue that given sufficient warning, and sufficient warning should be best practices, and those best practices should be reviewed on a regular basis, then yes, that is a point. The exception I would make is for vulnerable populations, where perhaps that threshold should be higher.
Mm-hmm. Just to add to that, if I may.
Just before you come, but we've had evidence from banks where they have told people that there's, and they've still sent the money.
Yes.
And just picking up on Lord Sharkey's question, I mean, surely it's ridiculous that they should be reimbursed in those circumstances.
I agree with you.
I would agree.
Yeah. So oftentimes, the nature of the scam is such that you're completely in spell.
Yeah.
Right? And even if you try to break the spell, they often do go ahead and make the transaction. In cases like that, right now the reimbursement regime does not go further as to establishing liability back to the consumer. What I would argue that we should do next is establish some sort of a challenge mechanism where the bank, the sending bank, can challenge back to the ombudsman potentially, saying that, hey, I did all these things. I have evidence here. I've shown them a video. I have given them sufficient warnings. I've even delayed the funds from being sent, and they still went ahead and did it. In that case, the consumer should be held liable. But right now, that challenge mechanism does not exist. It does exist if you look at card networks, right? And what I would also argue is going to happen as the reimbursement regime plays out is that you would actually see that fake scams are going to skyrocket. Because fraudsters, one big experience that we've had running Sardine is that they take advantage of every single law that is being created, right? So right now, the law is very much in favor of the consumer. So what prevents me from sending money to Simon, for example, from a brand new device? So, for example, I always use, let's take, for example, Revolut as an example. Maybe I installed Revolut on a brand new device, and then I claim that I was, my account got taken over and somebody else installed it, and then I sent money to Simon, and then we split the proceeds, right? And then we also go and get reimbursed, right? So these types of fake scams are going to just skyrocket unless we actually implement a challenge mechanism.
Well, I think there are two things on it. A challenge mechanism would clearly be a good idea, but notifying people they will lose their money. There will be no refund.
Consequence.
If they proceed.
Yeah, absolutely agree. Yeah.
Well, unless there are any other questions on that note of consensus, can we thank you very much for coming today and for being so patient in the start of the session and for giving us so much information both in the background and so on. We may come back to you with some further questions which we've not had a chance to cover today, and wish you every success in your endeavours to get at the fraudsters. Thank you very much.
Thank you.
That concludes this session.